listing options, then, I touched on a couple of these items. Firstly, you don't have to list. The majority of companies that do Reg A pluses do not list. Secondly, let's go down the stack. You can list on an alternative trading system. If you go to the Manhattan Street Capital website, you see behind me at the top right corner, there's a search box. And if you type ATS in that search box, then you'll see our content describing alternative trading systems. Anyway, an ATS is what I've said. It's a simpler method of listing. It's a new kind of exchange where stockbrokers are allowed to do the extra filings in order to become an ATS, an alternative trading system. And there's a large variety of them, probably 30 now that exist. There's too many, as is the case with new things, right? But that'll settle down over time. You can even get a private labeled ATS that you would use just for your investors in your company. Not to say that that's inexpensive. The level of integration that you would use and so forth will make it more expensive. But the point is that ATSs exist and that you have the same audit requirements as your Reg A Plus already does. So US GAAP audit once a year, 6 monthly management financials in the main. Once you've raised enough money and have enough liquidity to satisfy their requirements, and their requirements vary depending which ATS you're talking with, then you can list your stock there. You still have to file with the states for secondary market resale. So that's about $10,000 a year cost to do that. And I would say different ATSs charge different fee structures. Some of them more efficient in trading fees and so forth. But you can get about a $10,000 listing fee and about $10,000 a year to stay listed on an ATS. You can pay more than that, of course, but I do know there are a number that are doing it around that price. So the big advantage, though, the downside of these ATSs is that none of them have huge liquidity, and you're not going to get insanely high valuations, of course. That's the downside, straightforward and understandable. The upside, though, is that unlike on the OTC markets and on NASDAQ and NYSE, stock brokerages are not allowed to make naked shorts. So management is going to spend a lot less time worried about defending the stock price when you're on an ATS. So you're providing liquidity to your investors. And if you're continuing to raise money via Reg A Plus whilst listed on an ATS, which is a good thing to do, then you're establishing a price in the market by your marketing. And obviously then it's down to you to deliver with the company, deliver good results and communicate sufficiently to your investors. You are able, in a Reg A Plus, as far as the SEC is concerned, you're able to list in Canada, you're able to list internationally. And, you know, Asia has a number of exchanges that you can list on, and so does Europe. So that's another option to consider. The SEC ignores those liquidity options as long as your company is conducting itself legitimately and by the rules that those markets impose. You're allowed to list there, but obviously that doesn't help US investors, usually. Or I would say it doesn't help. It's pretty clear cut. It doesn't help US investors. You can conduct an IPO via underwritten support to the NASDAQ or the NYSE. That has the market obviously right now is not as excited about IPOs of any stripe, right? So we're not going to see too many IPOs in the next few quarters here as the market's in the state that it's in currently. But when the market is warm enough that underwriters want to play, then you can conduct IPOs to the major exchanges in Reg A Plus during the Reg A Plus. It's not something you're restricted to doing after it. As soon as you've raised enough money from enough investors that you qualify, then you can take your Reg A Plus and convert it into an IPO to those major exchanges. You don't necessarily, you have two options. You can do it via, you could do the last part via underwriters. So let's say you've already raised $16 million online in your Reg A Plus, and now you want to go list. That's probably enough money, assuming your burn rate isn't excessive, from enough investors to list. So 400 is a good number to start off with, but you'll be typically with 16 million, you'll have far more than 400 investors. Then you want to have capacity left to raise for the underwriters to make money, right? You've got to give them space to earn their keep, to pay their bills. And So in doing so, let's say you give them another $10 million to go out and raise in the IPO part, in their underwritten portion where they go to their broker-dealer syndicate and raise that extra money. Then you list. But you can also do a direct listing. And a direct listing is where you've already raised the money. You already have enough investors. You already have enough money in the bank, and you've satisfied the other listing requirements of NASDAQ. Like, when you look forward 18 months, you're not going to run out of money. They don't want companies to list that are, likely to run out of money in that kind of time frame for obvious reasons. So as long as you satisfy those listing requirements, then you can conduct a direct listing to the major exchanges without the use of a broker-dealer or even an underwriter or even a broker-dealer. So that's a lovely, lovely thing. What I like about that is it's much less expensive. You are able to do so even when underwriters won't play. So you hear this phrase, I've heard it many times over the years, the IPO window is closed, right? And what that means is you can't do IPOs unless, it's the latest startup by someone like Elon Musk. You get a few, but very, very few. So in that context, what does that mean? It doesn't mean the SEC has said, no, we're not going to allow any registration statements or Reg A plus IPOs anymore. No. They don't do that. They're not judging the merit of the case. They're not saying, no, you aren't good enough. You shouldn't go and market that company. It's the underwriters that say no, because it's not going to work in their view. It's not worth their time. They're going to have to work too hard to raise the money to go list your company. They're the ones that close the door. So if you've already raised enough money from enough investors and satisfy the other requirements, you can do a direct listing. There's one that has been done via Reg A plus, a company called Atlas. Their ticker symbol is AMV. They're on the NASDAQ. They went public at the beginning of October. Went public, their offering was a direct public listing. It wasn't an IPO, a direct public listing, right? So I gave them some advice in their preparations to do their direct listing. So I have some good awareness, and we have a good awareness of how direct listings work because we've been preparing to help our clients do direct listings for some long time. I see it as a marvelous opportunity because it reduces costs significantly. And again, if the company is strong enough and the marketing for it is strong enough, if the investor interest is there, that you already raised the money, then you can go and list on the NASDAQ. You just got to make sure you're prepared for the rigors of being a public company on a major exchange, of course. But the opportunity to do it this way, there haven't been a large number of direct listings in total via the NASDAQ or the NYSE, but those that have gone so far, almost all of them have been much larger companies, and they've usually involved underwriters that they were paying less. So they weren't making huge savings because it's a new space, it's a new area.